Okay guys, quick little video to help out with 6.23 for Harrison wholesalers. I understand there's a bit of difficulty with the GST and the transactions, and then I think casting our minds back to posting to ledgers and things like that, and how to treat GST in the ledger and the trial balance needs a little bit of work. So I'm just recording this as a bit of a backstop, okay, to help people in any area that you might be struggling with this question, whether it be GST in the journals, GST in the ledger, posting to a ledger, posting to a trial balance. Okay, these are we're going back to at your next exam. Your practical element will be journals, ledger, trial balance. So we need to really get our head back in the game with this. Okay, so I've gone ahead and already done the journal entries, but I want to step through them, okay, just to clarify any understanding. So our first journal entry, J. Harrison commences business with the following assets. Okay, so this is a fairly straightforward journal entry, which we've done before. We identify the accounts involved. Okay, debit cash at bank is an asset, it's increasing. Debit inventories 5,000, it's increasing. And debit motor vehicles 25,000, that is an increasing asset as well. It's J. Harrison commencing business, so the other side of the journal entry is owner's equity. Okay, so we've got our journal entry there: cash at bank, debit 40,000, asset; inventories, asset 5,000; motor vehicles, asset 25, and capital 70,000 to J. Harrison. Hopefully that's fairly straightforward. Okay, we move on to the next question, or next transaction. Purchased goods from manufacturers limited for $3,000. So the key here, guys, GST free. Okay, so there's only two transactions. We're not worrying about GST collected or GST credits received in this transaction because it's GST free. Okay, so we identify our two accounts. We've got purchased goods, which is inventories, because we're purchasing inventories. They're an increasing asset, so inventories is our debit account. We've bought them from Manufacturers Limited, who we now owe $3,000 to, so Manufacturers Limited is an accounts payable. So our next journal entry is debit inventories $3,000, accounts payable Manufacturers Limited $3,000, and we've got a narration there: purchased inventories, well, they were actually GST free inventories on credit for tax invoice at 1079. Hopefully that's alright. Okie doke. Next one. So we've bought some stuff, we've bought some inventories on the 3rd. Okay, it's arrived, we've checked it off. However, there's some stuff that's defective or more than what we need, so we've decided to send it back. So we've received an adjustment note from Manufacturers Limited for returns to the value of $220, still GST free. Okay, so we reverse that journal entry so that inventories, well, accounts payable Manufacturers Limited, they're going to reduce the amount of money that we owe them, so therefore that's a debit to accounts payable Manufacturers Limited, and we're going to reduce our inventory asset, so that becomes a credit for $220. So our next journal entry, accounts payable, debit to reduce the amount we owe them, and reduce the amount of inventories as well. Quick little narration there: inventory returns per adjustment note 191. Okie doke. Hopefully that's okay so far. We paid electricity account for $165, inclusive of GST. Okay, so we've paid money. Okay, so we go back to our golden rule here. Okay, if we sell something and we receive money, then we collect GST. So it's GST collected. If we pay some money for a particular good or service, okay, we're receiving tax credits, so it's GST credits received. So we paid electricity account $165. Our three accounts, we identify them: electricity expense, debit; GST credits received, debit; and we're paying cash, so cash at bank will be our credit. Okay, so we cash at bank. The gross amount of the transaction is the amount that our bank account is going down, so that's $165. We then do GST credits received is the gross amount divided by 11, and then so therefore the amount for our electricity is the gross amount minus GST, gives us that 150. Paid electricity per bank payment 172,496, just using the details that we've been given. Okay. Now we've sold some goods. So if we recall from the last couple of lessons, okay, if we've sold some inventories under the perpetual inventory system, we have two journal entries. First, we account for the sale of the goods, then we account for the transfer of those sold inventories at cost price out of our inventories and into cost of goods sold. So first of all, we deal with the sold goods at the sale price. Okay, key point here, GST free. So it's a little bit easier. We're not worrying about GST collected or GST credits received. So our our two accounts. First of all, to account for the sale, it's a bank deposit, so therefore we've received cash. We've received cash. Our cash at bank's going up, so it's going to be debit cash at bank and credit sales. Okay. So quite simply, cash at bank, debit 880, credit sales 880. Sold GST free inventories using the bank deposit that we were given. Okay, and so the second part of that journal entry, these items that we've sold had a cost price of $500. The cost of the goods that we sold were $500. So therefore we transfer that amount out of our inventories account up into the cost of goods sold account in our expenses. So we've got here debit cost of goods sold expense, increase that expense amount, and decrease our inventories asset account because the inventories have walked out the door. Okay, so they've disappeared. They're no longer an asset. They're gone. So therefore we reduce our inventories by $500. Narration using the details that we've been given. Okay, so the next one, I am going through these pretty quickly, but the beauty of these here is that you can pause it, rewind it, do whatever. Okay, just trying to get through them fairly quickly and then get onto the ledger. Okay, so we've sold some items, but unfortunately our customer, not so happy, sent some stuff back. So we've given them an adjustment note and given them cash back for $110, and the items that they returned, they had a cost price of $70. So we're essentially reversing our two journal entries that we did before, but for the new amounts, okay, only for the amounts that they've returned, and keeping in mind that this was a GST-free transaction. Both of these ones are. Okay, so first of all, we deal with the sales return. Okay, so send adjustment note, it's sales returns and allowances is the account that we're going to use, and it involves cash at bank. So our cash at bank's going down, okay, because we are refunding them money, so cash at bank goes down, cash at bank's going to be a credit. Sales returns and allowances are therefore our debit account. Okay, so we have sales returns and allowances for that amount, no GST on the transaction, and our cash at bank is going down the $110 that we've refunded them. And we keep going as well. Okay, our inventories. Okay, the transaction says the cost of those inventories that they've returned was $70. So we're going to put that amount, take it back out of our cost of goods sold and put it back into the inventories account. We do that by debiting inventories. Okay, increase inventories again, and decrease our cost of goods sold account, or cost of goods sold expense account, by crediting it. Okay, narration using the details we've been given, and we go on to the next transaction. Okay, this one here, we've purchased some goods including GST. Okay, so our three accounts that we're going to use. Okay, we've purchased some goods, so we're buying inventories, so it's going to be inventories asset account, debit. It includes GST, and we are paying money, we're buying stuff. Therefore, we're receiving GST credits. So our debit will be GST credits received. And we've paid from the bank account, so our bank account is going to be going down. So cash at bank will be our credit for the gross amount of the transaction, the full amount. Okay, so our transaction is, first of all, cash at bank credit is the full amount of the transaction. Our GST credits received equals the gross amount divided by 11. And therefore our inventories equals the gross amount minus the GST. Okay, debit inventories, debit GST credits received, credit cash at bank. Okie doke. Next one is a sale transaction. Okay, so we know that we're going to have two journal entries here. We've sold goods with a cost price of $100. Okay, so that's our cost of goods sold amount here. We've sold it to H. Jones for $165, including GST. Okay, so two journal entries. First of all, we will account for the sale. Okay, we've sold it to H. Jones. There's no mention of cash here. Okay, so we've sold it to H. Jones. H. Jones will therefore be an accounts receivable, an asset. H. Jones owes us the full amount of the transaction. Okay, so it's going to be debit accounts receivable H. Jones for $165. On the credit side of our journal entry, we're going to have GST collected. We're selling stuff here. Okay, we are collecting GST therefore from our customers on behalf of the tax office. So it's GST collected will be a credit, and the other account being sales. Alright, so our journal entry looks like this. Accounts receivable H. Jones $165. Okay, GST collected is 1/11 of the gross amount, and therefore our sales amount, or what we call the net amount of the transaction, is the gross amount of the transaction minus the GST gives us the sales. Okay. A narration using the details we've been given. Alright, and so the transaction said the item that we sold to H. Jones had a cost price of $100. So we need to account for the transfer of the cost of goods sold out of the inventories account in the cost of goods sold. So we're debiting the expense account cost of goods sold for the cost price and decreasing our inventories for $100. Alright. Hopefully it's making sense. Okay, so here we are paying Manufacturers Limited. Okay, so up here we bought some stuff from Manufacturers Limited on credit. We look at the journal entry up here. Okay, we bought some stuff on credit, so we owe them $3,000. Keep in mind these were GST free goods as well, but if there was GST on the transaction, this is where the GST would be accounted for. Where we simply pay an accounts payable, there's no extra GST on that transaction. We're just paying the amount that we owe them. So regardless, when we pay an accounts payable or we receive money from an accounts receivable, there is no GST. Okay, the GST is accounted for when we bought the goods or when we originally purchased the goods, if there is GST in the transaction. Okay, so this one here, paid Manufacturers Limited. So we're going to decrease our accounts payable and we're going to decrease our bank account. So if we're decreasing an accounts payable liability, we debit it. If we're decreasing our bank, we are crediting it. So our journal entry looks like this here. Where are we? Back down here. Okay, so we're paying it Manufacturers Limited. So we decrease the accounts payable, so we debit it, and our bank account is going down. So therefore, that's $1,000 credit. All right, last transaction, paid wages, easy one. Okay, in every wages transaction, okay, there is no GST on wages. Okay, there's other taxes, there's income tax and things like that that get accounted for separately, which we're not worrying about in what we're studying at the moment. We just know that there's no GST ever on wages. Okay, so here we paid wages using our cash bank. Okay, so we debit wages expense $1,600, credit cash at bank $1,600. Okay, wages and salaries debit, 1600. Credit, cash at bank, 1600. Alright, well that's all of the journal entries done. So I really wanted to focus on, hopefully that, if you had any queries, that helps to explain any issues that you might have had. Alright, because I wanted to get on to posting to the journal entry, posting to the ledger, and casting our mind back pretty much a term. Alright, so first of all, if we're struggling, how about we do a chart of accounts? Okay, so we start off with 100 is our revenue accounts. 200 expenses, 300 assets, 400 liabilities, and 500 is our owner's equity accounts. So we'll go down this list here, okay, and we will identify the accounts that we've used and populate our chart of accounts. So let's go down the list. Okay, cash at bank, order of liquidity, always first, 301, cash at bank. I'm just going to color code this. Do I need to color code it? No, it'll be right. Okay, so what we will then have, we will have accounts receivable. We'll go next. Okay, but we'll work down the list because so that we don't get ourselves messed up. Let's put 302 inventories in there. Okay, we're pretty sure that we're going to have accounts receivable. Accounts receivable will go above inventories, but we'll deal with that when we get there. Okay, motor vehicles is another asset. We're just going to put this in here. Okay, and then we've got capital, 70,000, so that's owner's equity. 501, capital, J. Harrison. Alright, so that's all of those ones done. Inventories we've already got. Okay, accounts payable, manufacturers limited. So I think we've only got the one accounts payable, so we'll just accounts payable. Spelling. Manufacturers limited. Okay, so that's that one. Accounts payable, manufacturers limited, got it. Inventories, got it. Electricity expense, we need to add that in. Come over here, 201. Oh. Electricity 201. Okay, now this is where we cover some new territory. Okay, our GST needs to go into our ledger, into our chart of accounts. And we've talked about before how, and if you look back in the textbook, there are examples in the trial balance, even on page 195, how they treat GST collected and GST credits received on a trial balance. So we treat both GST collected and GST credits received as liabilities. Okay, GST collected being the genuine liability. So we're going to sub-account these. 402.1. I'm just going to widen that. I'm going to put in here GST collected. So GST we would typically put after accounts payable in our chart of accounts and before any other loans or anything like that. Okay, so we know that we're going to have GST collected and GST credits received. I'm only up to here, but I know we've got GST collected, so I'm just putting it in now. Okay, so we've sub-accounted them because they go together in liabilities. If I could spell. Okay, GST credits received. So we've got that one in there, and we've got cash at bank, already used it, already used cash at bank. Okay, we need to add sales. So 101, sales, got it. Cost of goods sold. Okay, so typically your cost of goods sold is going to be your first account. So I'm going to shift this one down here. MA cost of goods sold. Okay, so cost of goods sold goes up into our trading account, as I talked about a lesson or two ago. And we'll cover that in more detail, but cost of goods sold in a trading business is always going to be your first expense. Okay, regardless of alphabetical order, cost of goods sold goes at the top. Okay, cost of goods sold, we've used it. Inventories, we've got it. Sales returns and allowances. Okay, sales returns and allowances will typically be a debit, but it offsets, it reduces sales. Okay, so we're going to put it into our revenue underneath sales. We could even sub-account that as well. I'm just going to leave that as 102 for the moment. Cash at bank, we've used it. Inventories, we've got it. Cost of goods sold, we've got it. Inventories, we've got. GST credits received. Cash at bank, got all of those. Accounts receivable, H. Jones. Okay, so what I'm going to do, accounts receivable needs to go in up here. So I'm just going to get these two and just drag them down. Create some room here for my accounts receivable. H. Jones. Okay, so we've got that. GST collected, we included before. Sales, we've added. Cost of goods sold, we've added. Inventories, we've got. Accounts payable, manufacturers limited, we've got. Cash at bank, wages and salaries, we need to add in as well. Wages and salaries, and cash at bank we've got. Okay, so there is our chart of accounts for all of these journal entries that we've done. So the next step then is to go and create our ledger and our trial balance. What I might do, I might break this into 2 videos so that you don't have to spend so much time wading through one. Okay, so we'll make this one journals and chart of accounts and move on to ledger and trial balance in the next one.